Kaj, even though market's not doing as well, what's your take? 1.5% lower. You had some updates coming through, consumer companies, lenders. What's your initial sense, this kind of reaction, 1.5% lower?
Well, Harsh, it's a classical profit booking that we are seeing in Indian markets. Indian markets have done pretty well. And probably it's some degree of profit booking that we are seeing at the start of the year and probably before the earnings season. It's to some extent driven by the fact that the fact is India is the most expensive equity market in the world. And more importantly, the economy is experiencing a cyclical slowdown. We saw that the second quarter GDP number was 5.4%. Probably third quarter will see some recovery, but yet on a full year basis this year, there is I don't think, meaning the consensus estimate is that the economy will do a 6.5% kind of a growth. So there is, and probably aggregate level index earnings will grow at now mid-single digit for this year. So combination of slowing earnings growth because of the slowdown in the economy and markets having done well and expensive valuations is what driving profit taking in the market at this point of time, I would believe.
Fair point. Let me touch upon earnings because that's something you spoke about. Do you expect the bottom to be Q3, Q4? Do you expect a bit of a pickup in H2? What's the sense like? We're, of course, right at the cusp of the Q3 numbers.
Well, second quarter numbers were pretty poor. I think we'll see some revival or some recovery in earnings in the third quarter numbers as we get into this earnings. But yet, that earnings recovery will be a fairly modest recovery. We are not expecting a very sharp recovery or sharp bounce in earnings in that sense. I think the economy has hit a slow patch and probably earnings will remain tepid or moderate for the next few quarters, and which is what I think is leading to this round of profit taking, especially from international investors.
Thank you so much for that. Let's ask you something about IT as TCS kicks off the earnings season by reporting on the 9th. What's your take on IT? Most of them are bullish on the street, but what's your perspective?
Well, the outlook on the sector remains positive, but we need to keep in mind that this quarter, as it is October-December quarter, is a seasonally weak quarter for IT companies because we have the highest number of furloughs in this quarter. So from a reported earnings perspective, probably numbers on a Y&Y basis will still be okay, but on a sequential basis, because of seasonally weak quarter, they'll be modest. But I think what is more important in case of IT companies is outlook going forward now, because the election uncertainty is out in is over. There is an expectation of recovery of discretionary spends in US, and probably we are seeing early signs of that from commentary from US companies in their earnings. So I think everyone will be looking to what outlook Indian companies give in terms of whether in terms of the pipeline going forward. But I still think IT as a sector is a buy and dip sector. So probably take a medium-term view. We think we'll see a recovery in the IT spends, and it's a sector where one should buy on to every dip.
Pankaj, what do you make of the FIIs now? What's the sense? We are 3-4 days now into the new year, but it's been just a couple of working days as of date for FIIs to work with. What's the sense like for January? What's your outlook rolling towards the budget?
Well, it's difficult to take a view on a weekly or monthly basis on FII flows, but it's fairly possible that it's the start of the year, given the fact that India is, as I said, the most expensive equity market in the world, and we have a economic and earnings slowdown. It makes logical sense for a lot of these investors who've been overweight India for the last few years and where they've made handsome money to probably take that money away from India and reallocate to some of the other markets which are much more cheaper in terms of valuations. And probably, at least in the short term, probably they might show a better growth for the next 1 or 2 quarters. But it makes sense or probably logical this thing for these guys to take some money off the table. But yet I still believe that on a full year basis, probably towards starting from the second quarter onwards, we should start seeing positive flows from FIs because India still remains the best secular growth story out there.
And what's your sense with regard to commodities? Gold, silver, they've really outperformed. Gold, more in the longer term as well, has outperformed equities. But silver in the shorter term has done ever so well. What's the sense now? If at all you have an allocation, would you allocate at this point?
Well, we don't invest in commodities, and I'm neither an expert on precious metals. But from my understanding, Probably silver is also an industrial metals, so which is what is driving the demand for silver, apart from being a store of value, which holds true for gold and silver. And probably from the data that I have seen, we have seen that central banks, including the Chinese central banks, have been buying into the have been increasing their stock of gold, and which is where the correlation between a stronger dollar and a weaker gold prices has actually broken this time, because despite dollar being strong, gold prices have held through, and that's because of demand from global central banks, including the Chinese central banks, which has been one of the major buyers.
And Pankaj, given all of this context, given slightly weakened rupee as well, and likely to continue to weaken, what's the sense like? What is the pocket you would like to invest in? Of course, either today or if you see a deeper gash in markets going forward as well. Sense.
So I think investors should take a slightly more medium-term view. This is a great time for investors to invest into Indian equities, because India still remains, while, as I said, the economy is into a cyclical slowdown, but India still remains the most compelling secular growth story. And I certainly think second half of this year, the economy should revive or recover. And probably this would be a good time to build one's long-term portfolio, or probably if one is sitting on cash, to allocate more money into equities. We clearly like IT because we think we'll see a recovery in earnings growth for the IT as a sector going into the next year, that is FY26. And apart from that, we also like banks because we think valuations there are fairly reasonable, and the larger banks are doing reasonably well. And also it's a sector which is coming out of 2 years of underperformance. So we like banks as a sector, and apart from that, we like healthcare as a sector as well.
What's the theme on banks, Pankaj? It's interesting that you say banks, because nearly every bank is facing one or more set of challenges which they are finding very difficult to overcome in a very short period of time. They're taking multiple quarters to come out of either an RBI embargo or either for example, a special situation. You have the heavyweight in that situation. How should one, or how do you look at banks, and how quickly do you expect them to bounce back and give decent returns?
So, well, Harsh, your point is well taken, but I think all of that is well into the price of stocks in that sense. What we really expect is probably India, we should get our first rate cut sometime, if not February, certainly in March. And probably deposit growth in the system should improve. Also this year, the loan growth has slowed down, but I still think that the loan growth can get back to about 14% kind of a number, 13 to 15% kind of a number going into the next year. The good thing is good banks are sitting on pretty healthy balance sheets with very low NPAs in that sense. We have seen some NPA emerging, but that's largely in the MF segment, and that's more concentrated with microfinance lenders. But apart from that, the asset quality in the banking sector is pretty healthy in that sense. So we think going into the next year, we should see a recovery in earnings growth for banks. And valuations in the sector are pretty reasonable. It's one of those sectors which is trading at almost about 30% discount to the index, Nifty index valuations, and the discount to the index is at this point of time over 2 standard deviation than what normally the sector is experienced. So we think a combination of reasonably attractive valuations and a pickup in earnings growth going into the next year should drive performance in the sector in the
Pankaj, last couple of questions. I know I'm holding you back. One is with regard to consumption. You see a bounce back. We had 3-4 companies declare numbers, a Jubilant, a Titan, a Nykaa, good solid numbers. You expect consumption to bounce back. What are those factors you look out for to expect a recovery, maybe second half of this calendar year?
So, second half of the year, certainly we expect a revival in consumption, because it's now almost 6 quarters that we've seen a slowdown in the consumption. It started slowing down in the rural consumption, and then it spread over to urban consumption. It's pretty heartening to see some very strong numbers from companies like Jubilant, Titan, and Nykaa as well that you mentioned. But I think this quarter will probably be a quarter, and some of these stellar numbers from some of these companies are more about these companies' own excellent execution than a broader reflection on the revival in the consumption. So we still think that while the worst, probably the low point in consumption is behind us, but the recovery from here will be slightly more gradual. And I think a meaningful recovery in the consumption will probably happen the second half of this calendar probably after we get a good monsoon this year.
Guys, last question. The fears of the new virus, is that at all bothering you? Is it on your mind?
Not really. I think the world is well prepared to deal with any such eventuality. Bear in mind, I know all of us as human beings have the recency bias, but the last time we had a pandemic before the COVID was in 1904. So as long as the world is prepared, I think probably we can contain it much better, unlike COVID, where the world was clearly not prepared for it because we did not have a precedent. But I think, one, I'm not sure how potent it is.
Fair, Pankaj.
Prepared to deal with this kind of a contingency.
Fair. Okay. Thank you so much, Pankaj, for all of that perspective. It's great having you on a day like this. Always calms the nerves to a certain extent, and that was obviously the hope. Thanks for coming in and speaking with us.